So we were doing variance analysis, and what we are doing, what we are doing is like basic variance. You know, basic variances are from your ACCF2 syllabus, but we still need to do them here as well. Uh, so let's continue on basic, then we move to mix and yield variance. And by the way, we need to do mix and yield variance, which is little bit complicated, not a lot. And then we have to do, you know, operational and planning variance, which is very easy. So operational and planning, so these two, we call them advanced variances, or you call it further variances. And then you have basic. In basic variance analysis, we call them, you know, variable cost variances, which we started last time. And under variable cost variances, you have 6 variances. So there are 6 variable cost variances. You call it material price variance. You call it material usage variance. We did that before in last lesson. You call it labor rate variance. You call it labor efficiency variance. And you should remember that material price variance, this looks very much as labor rate variance. We talk both about that, how much are we spending on that. Then we have variable overhead, you know, spending variance, which is exactly the same like you calculate these one. Material price variance is about how much you are spending. Labor rate variance means how much you are spending on labor. Variable overhead spending variance, how much you are spending on variable overhead. And you've got variable overhead efficiency variance. So how do I see them in my mind? That this material usage variance is about consumption of material, okay? And this labor labor efficiency variance, it's not rate efficiency, it's labor efficiency. Labor efficiency variance is again about consumption of labor, the time you are spending. And variable overhead efficiency variance is also about the time, the speed. So this is usage, this is usage, this is kind of usage. They are very much related to each other. And when you do one or two, when you have done your labor rate or labor efficiency, you can very easily do your variable overhead variances in the same way. Nothing different. So these are called 6 variable cost variances. After that, we have sales variance. And this is what we are going to do now. You've got sales variance. And within sales, you have sales price variance. Again, how much you are spending. And sales volume variance. And sales volume variance, actually, you have 2 of them. So you have 1 sales price and 2 for volume. How it happens, I will explain. And then we have got fixed cost variances, fixed overhead variances. So these, all of them together, and you've got 3 of them here, okay? All of these are called your basic variances. And these actually, they come from F2, but they are repeated in F5 as well. So let's start with sales variances. So if I start with sales variance, first is sales price variance. So how do we calculate that? Okay, let me create some scenario. We say that, let's create a scenario. We say during a period, budgeted sales volume was 5,000 units and budgeted sales price was $12. Okay, this is what we supposed. This was our budget for the next month. And we say that actual sales volume was, you know, let's call it 68,000, was $68,000. And sales volume was 6,000 units. This is what you did. So now they ask you to calculate the sales price variance and sales volume variance. Okay, so sales price variance. First, we calculate sales price variance. So it's very simple, and that's why we call them basic variances. Sales price variance. Again, the same concept. The same concept, like you have to always think about actual activity, okay? How much was the actual activity? Actual activity is 6,000 units. So you should be saying that, 6,000 units, how much they should be sold for. So you should say 6,000 units should be sold at $12 for. So it is 6,000 times 12, 72,000. And then we say that 6,000 units were actually sold for $68,000. So you sold for less. So definitely you have an adverse variance. So there is a $4,000 adverse, okay? So this is your sales price variance. Sales price variance is $4,000 adverse. It's very much simple. It's pretty much the same. Like if I'm selling 6,000 units, my standard price, my budgeted price was 12. So I should have made a revenue of 72, but we made sales for only 68. So it means that probably we gave some discounts. Our sales price was less. And we lost $4,000 just because of our selling price, okay? So there is a $4,000 loss of profit just because of your selling price. And then you need to calculate sales volume variance. And sales volume variance should always be like very simple. You say budgeted sales price, budgeted sales volume, and you've got actual sales volume. Your budgeted sales volume was 5,000 units. Your actual sales volume was 6,000 units. So now it is favorable because you sold more, and when you sell more, you make more profits. Usually. So you've got 1,000 units. Now you should remember that it is in units. So you've got sales volume variance as 1,000 units favorable. Now, the thing is that we discussed it earlier that variances are never expressed in terms of units or kilograms or kilometers. Variances you always calculate in terms of dollars. So we must be multiplying this $1,000 unit number, we have to multiply it with some dollar value. And maybe sometimes students, they think that the dollar value can be 12, for example, because the cost or the selling price of one unit was 12. So you multiply it with 12 and you say that, okay, we sold 1,000 units more. Each unit gave me $12. So I have $12,000 favorable, which is not true. Which is not true because you cannot multiply it with 12, okay? You cannot simply multiply it with 12 because if you remember that variances we were calculating as the difference between the expected profit and the actual profit. Variance, we were calculating the difference in the profit. 12 is not your profit. 12 is your selling price. You should be talking about profit. And here comes the correction, because I told you that there are two types of sales variances. Sales volume variance, you have two, okay? Two sales volume variance. So what do you have? So you should never be referring it to as sales volume variance. There is nothing as such sales volume variance. It is not a complete expression. You should be saying sales volume, contribution margin, or profit margin, okay? Any one of them. So either it should be sales volume contribution margin variance, or it should be sales volume profit margin variance. It cannot be just sales volume variance. So whenever I ask you, or you see in the question, calculate sales volume variance, the first thing which comes to your mind, sales volume contribution margin or sales volume profit margin, which one? So because I know that it is 1,000 units, I sold 1,000 units more. But by selling 1,000 units more, how much additional contribution did I make? Or how much additional profit did I make? So what you need to know now, for example, you've got sales price. So let's put the data sales price, which is 12. And then we have got our material, our labor, our variable overheads, and our fixed overheads, okay? So I put numbers here. For example, material is 5, this is labor. And labor is, let's suppose 2, or let's call it 3. Variable overhead is 1, fixed overhead is 1. So if you take this data, you have got contribution and you can calculate your profit. Now, you know that contribution means sales minus the variable cost, which means sales, which means 12 minus the variable cost, labor 5, minus material, minus labor, minus your variable overhead. Your contribution is 3. And if you talk about profit, it is 12 minus 5 minus 3 minus 1 minus 1. Your profit is $2. I mean, each unit is giving you $3 in contribution, or alternatively $2 in profit. So now, which one should I multiply? Should I multiply it with 3 or should I multiply it with 2? That's the question. So here you go back to the question, okay? In exam, they will tell you, they will make the statement like this: the company uses, marginal costing system. Or they may say that the company uses absorption costing system. So either they are using absorption costing or they are using marginal costing. If they use marginal costing, you will be using contribution margin. If they are working on absorption costing, you should be using on profit, okay? So let's suppose, in our case, let's suppose we say that the company is using absorption costing system. So then you should be multiplying it with 2, and you would say that my sales volume profit margin variance, I would just make it red, sales volume profit margin variance is $2,000 favorable, which means that we sold 1,000 units extra, more than what we planned. And as a result of selling 1,000 unit more, we made $2,000 more profit. So this is your sales variances. 2 types of sales variances. What we need to do in this is called basic actually. What we are going to do in F5, we will have sales mix variance. And when I will start F5 variances, I will show you then. Sales mix variances. Sales mix variances is like advanced topic. It means that you sell different types of products. On some products, you make more profit. On some products, you make less profit. And you have budgeted sales volume. For example, you sell, you have soups and you've got, I don't know, the main course. Let's call it like this. It's a restaurant. They plan to sell 100 soups. They had a budget of 100 soups and they want to sell, for example, 100 main meals. And here they thought they would make $2. Here they thought they will make $4. And they were planning to make like this much of contribution is expected. So this is quantity. This is, say, my contribution. And this is my total contribution. But maybe in some period, they will change this combination. What will happen that this is what you thought, but then what happened that you sold soups more, like 125, and you sold main courses like 70, or maybe, I don't know, 60. So your contribution will change. This thing is called sales mix variance. This is what we will do in when we will move to F5 questions. We will do sales mix variance. As far as our basic variance is concerned, sales variance is only sales price variance and sales volume variance. Yes, further variance analysis, sales mix variance we will do.